I believe that, once after 5, 6 years, it's very difficult to change a person in investing. I've tried to take people without investing backgrounds. Cycle thinking has got ingrained in us. When you're in the middle of this pendulum, you don't know what to do. That is a challenge. But the extremes, you will see herd behavior. Investing is not arithmetic. You can't just assemble a team of highest IQ people and say we are going to achieve the best returns. You're not going to achieve it because there is more than just IQ which determines who wins. It's not that the day we bought metals, the next day we made money. We first went through a heart-wrenching process of losing money relatively. Then after that we made tremendous money, but that required internal support groups. Some of the tech stocks in US and like Microsoft or Google bought it 10-20 years back and then sat on it. There was structural technology has been a structural trend. I'm worried whether 10-20 years back, if I was a US equity fund manager, which I'm not, would I have done it, is something I'm asking myself. That's how you manage to hold on to the stock. Do anything, but don't be a full-time investor.
Hello all, welcome to Know Your Fund Manager series. I'm Sankaran from Zerodha, Varsity. In this episode, we have with us Sankaran Naren, the Chief Investment Officer of ICICI Pru Mutual Fund. He manages more than 7 lakh crore of funds as of today. Naren developed interest for stock market investing pretty early in his life. When everyone considered annual reports as waste paper, he used to go to the waste mart, collect these annual reports, read them and invest in companies. Though an engineer from IIT Madras, he later pursued MBA from IIM Kolkata. In early 2000s, he moved from Chennai to Mumbai to pursue his career in the fund management industry. If you know a bit about Naren, you know that he follows a contrarian style of investing. What is contrarian style of investing? And when does it work? When does it not work? And most importantly, what to expect when you are investing in his funds? If you want answers for these questions, this is the episode to watch. For me personally, this is one of the most interesting discussions I had on the stock markets. I hope you find this conversation as enjoyable as Naren and I did. Mr. Naren, thank you so much for joining us today. In this Know Your Fund Manager series, we really, truly want to make people understand the style of the fund manager. Of course, you've talked in multiple forums and you're a very well-known fund manager in India. But maybe in our style, we just wanted to bring out and focus on your style of investing and what should investors expect when they're investing in your funds. So thank you so much for joining us.
My pleasure.
As Mark Sellers said, one of the famous fund managers, you also referred to him, once in a while. He said that there are 7 traits for a person to become a successful investor. And it goes from saying that the person has to have the ability to pick stocks when others are panicking, should have this obsessiveness to play the game and, win the game, and the ability to withstand the volatility. There are 7 traits like that. But at the end, he also says that one cannot develop these traits once they reach the adulthood. It's only as a child they can have these traits. You as a successful fund manager and successful career in stock market, do you think starting early has helped you?
It certainly has helped me. There is no doubt about that. I have done investing right from early age. And one of the things I have inculcated at ICICI Prudential is actually hiring freshers because of Mark Sellers' interview. I actually ensure that everyone who has joined my company has read the Mark Sellers talk. And I keep sending that talk mail at least once in 6 months to everyone in my team. Because I believe that, once after 5-6 years, it's very difficult to change a person in investing. And I believe that it is necessary for them to read that Mark Sellers speech. I think it's one of the most outstanding speeches in investing, in my opinion, particularly for a fund manager. But I'm hoping, I've been trying my best that if people can, when they join ICICI Mutual Fund and if they have not learnt investing before, And I've tried to take people without investing backgrounds, and then maybe it's possible to train them in this framework. And so far, if you look at our track record at ICICI Prudential, it has been reasonable, and I hope it continues. And that is based on Mark Seller's speech.
Awesome. And not just that, I've also come across a lot of stories of yours. I remember reading that as a child, you used to go to the waste, marts near your home, buy the annual reports, which are not worth higher price, but paying higher price and buying them. People used to wonder why you're buying that. I think that passion can't be copied.
Yeah, that happened when I was in engineering and onwards. And that was a non-internet, non-CNBC era. So the ability to make money just by reading annual reports was possible. And it was an era where people did not know how to read annual reports. Today, thanks to internet, thanks to the entire generation that exists, the ability to make money just by reading annual reports is gone, actually. So I think we had luck in 1990s that we could go to a Raddiwala, buy annual reports and make money. I remember reading some annual reports where the standalone EPS and the consolidated EPS were very different, and the consolidated earnings per share was 4 times the standalone, and people didn't know how to evaluate it. Today, such things are just impossible, actually.
So as per my research, for an investor to know your style of investing, I think there are 6 things. I know I have these cards here. I'm sure you don't know what's there in this. The first thing I think people should know about you is this contrarian style of investing. To say that, maybe I'm just using this as an example. Consider this as a pendulum. This is not a pendulum, but consider this as a pendulum. And use most of the market experts also compare markets to a pendulum, saying that it moves from one direction to another direction, and on one direction there is excitement, euphoria, on the other direction there is fear, panic selling, and it moves from these cycles are more common in markets than we usually often tend to believe. One of the common investing lessons that we learn soon after we enter this space is buy when others are fearful and sell when others are greedy. I want to understand how important it is for you to understand these cycles in your style of investing.
It is very important. And what we did at ICICI Prudential is actually work hard to popularize balanced advantage as a category. So there it became institutionalized. So if you look at balanced advantage as a category, it became very smooth. That buys when markets are very cheap and sells as the markets are up. So that itself became something which became institutionalized, and after us, all the people have worked to expanding the category, frankly. So I think it is very important to understand cycles, and it has been tough because last 10 years we have seen lesser cycles. And if you look at it, we have seen cycles in many other parts of the world, but barring the COVID cycle, the cycles have not been very deep in India. So I think, but it's important, but we have seen contrarianism work in sectors very well. So we have seen that works much better. But on markets, if you look at it, last 10 years, we have not had a down year in equities. Frankly, we believe that at some point of time, there will be down years in equities, but it has not happened actually. So whereas if you look at what has happened in China or what has happened even at some point of time in NASDAQ, you have seen big falls in some of the markets, and we are prepared. We have created categories like balanced advantage so that they can benefit from market falls, like what happened in March 2020.
Right. So when you're referring to contrarian and the cycles, it's mostly the sectoral cycles that you refer to.
What happened was only sectoral cycles in the last 10 years, barring COVID. And but otherwise, if you look at, for example, 90s, or even the period between 2007 and 2013, you had big market falls in 2008 and 2011. So it is only this period where we have not had falls. So if you look at 90s, there have been periods of time when markets have crashed. So I believe that this is a situation which exists. If you take real estate did not go where all the way from 2013 to 2020. For 7 years, real estate didn't go anywhere, actually, the physical real estate as an asset class. So we believe in contrarianism, and we believe in sometimes sideways or even declines, but it hasn't happened in equity markets in India. Partly because I think the macroeconomic handling of the Indian economy has been very good in the last 10 years.
But you look at cycles when it comes to sectoral.
Yes, there it has worked. For example, if you look at 2020, we identified telecom, metals, PSUs, and those things worked very well, actually, because the cycle, if you looked at metals, for example, they had done very badly for a long period of time. Telecom went through a big down cycle. Most of the PSU stocks had done very badly till 2020. And those sectoral cycles, or even I would say ownership-based cycles, they work very well, actually, for us.
When someone is referring to macros, and when you also talk about looking at macros, is it these sectoral cycles that you're looking at?
So actually, macro can be looked at differently. Like, for example, if you take US as an example, you have a situation where they allowed inflation to go out of control. Then what happens is then US yields went out of control. So whereas in India, inflation has been under control for the last decade. So you have had a situation where yields in India have been range bound. The US 10-year moved up substantially, whereas in India the yields have been range bound. So you can have situation where macro can be in things like currency. Currencies have also been range bound in India. Dollar rupee has been much more range bound. Whereas if you look at some of the currencies, you should look at what has happened to Turkish currency. It has just gone collapsed, actually. If you look some of the African currencies like Naira, they have just collapsed. So if you look at it, if you handle macro well, some of the cycles don't play out. That's why we have been forced to look only at sectoral cycles, because the Indian macro has been handled very well.
Brilliant. Howard Marks, when he's talking about these cycles, he says that the best way one can predict what cycle we are in is to think probabilistically. Just referring to this chart, this is a chart that's representing the cycle of any sector or market. Maybe if you can just take 2 to 3, maybe, or one stage in the cycle and say, how do you identify, maybe not now, which cycle we are in? Like generally, what are the signs you look at to decide which cycle we are in generally?
So I'll give you an example of metals. In 2015-16, I met some metal companies in steel. Those companies told us, except these two companies, all of us are bankrupt. So when they told us in a meeting, you reach the bottom. And when they tell you that every company is bankrupt except these two, and all of us are bankrupt, you're at the bottom of the metal cycle. So which means you can comfortably buy that sector from an equity point of view. If you go back to telecom in this period from 2019-20, you had a situation where almost everyone in telecom was bleeding, and the number of players had come down to such a low level. You could have looked at telecom results. You would have found that barring one company, all the others were making huge losses. So that again actually showed extreme, I would say, a situation where you knew that you were at the bottom. Go back to 99-2000, you'll find a new valuation model will come called eyeballs. So people will say, based on eyeballs, you can invest. Go back to 2017. Since you are from Bangalore right now, you will know that people are started to look at something called based on value of sale. You could sell a mobile phone based on losses, but people were giving valuation based on value of sale. Once you have a model, which is basically you could create valuation based on just volume or value without any reference to profit, like whether it is eyeball or gross merchandise value, there's a problem. Then you're closer to the top of a cycle. Then, as you know, many of those startups, actually their valuations came down. So that is an indicator of a top. So actually, we have a model internally that if you have too many IPOs in a sector, you have to be very careful. Then if you have too many buybacks in a sector, it means you have to be very positive. So these are some of the ways in which we try to identify which are the sectors to be positive on, the sectors to be negative on. Because I think if you have so many IPOs coming in a sector, I think managements know what the valuations are. Then they keep on coming out with IPOs. So that is how we identify sometimes cycles. And you can make out, if everyone is worried about your making too much money, then it means that actually we are towards the top of a cycle. On the other hand, if there is complete irritation, which must be happening today, let's say in the Chinese stock market or something like that, you're closer towards the bottom. So you have a situation where you will know where you are actually by it's too easy. It is the bottom and top is easy. Somewhere in between is tough. Because in this in between, you do not know. When you are in the middle of this pendulum, you don't know what to do. That is a challenge. But the extremes, you will see herd behavior. You will realize that herd behavior is so evident at the extremes. So you will see a situation like 1994, where an open-ended mutual fund had a grey market premium. Can you believe that? How can it be in 1994, an open-ended mutual fund can have a grey market premium? On the other hand, in 1998, that same mutual fund or something like that was trading at a discount of 40% on net asset value. So what I'm saying is these kind of extremes you will be able to see, and that will give you an idea of where you are on the sentiment cycle. So in extremes, it is easy. But in the middle, it is not easy because you won't know what's happening. You won't know how long this cycle will go on. But you'll be able to identify at extremes. And when extremes happen, you can be surer that you're not far away, actually.
You talked about how long it takes, right? So the basic principle of this contrarian investing is that the cycles tend to mean revert. Yes. So when you are choosing that, okay, fine, we are taking this contrarian call. So do you have some expectation on how long it takes to play out?
No, because sometimes some of these cycles, take for example the negative cycle which happened in Japan. It went on from 1990 to 2022. One whole generation said there's no hope in Japanese equity. Even today, in Japanese equity, there are so many people who don't want to invest. Can you believe in Japan, there are banks which give you a dividend yield of 5% and the deposit rate there is minus 0.2%. Try telling that to an Indian that I will not invest in the stock, which gives a dividend yield of 5%, but I'll invest in the deposit and gives me a minus 0.2% per annum interest, minus 0.2%. So what happens is that because 32 years stock market did not deliver returns in Japan. On the other hand, you have markets like, US, where NASDAQ kind of markets have been positive for long periods of time. In 90s, there was one run. Recently, there has been one run. You know about the FANG stocks and all that. So I believe there are cycles which can go on. You can't predict. And that is why we are, as I keep telling my younger colleagues and all these people, who are very, very strong numerically, I tell them this is not arithmetic. If it was arithmetic, all Nobel Prize winners would have won. You've heard of this LTCM, which had so many Nobel Prize winners. They drove that fund to bankruptcy. Despite having so many Nobel Prize winners, that fund went bankrupt because this is not arithmetic. Investing is not arithmetic. You can't just assemble a team of highest IQ people and say we are going to achieve the best returns. You're not going to achieve it because there is more than just IQ which determines who wins. And this is something Warren Buffett has been repeatedly saying.
I just want to understand that part on how long. So how will you consider that, when you don't know how long a cycle takes to play out, then how can we take a decision?
You can't take a decision. The honest truth is that it is tough for a person like me to say I don't know everything. For example, there was a time we used to be cautious on FMCG stocks. Now, FMCG stocks never underperformed. Finally, in the last 3 years, they have underperformed massively in the last 4 years. Now, did we know that it will start underperforming from 2020? Answer is no. In the recent past, we have been cautious on small and mid caps. Has it underperformed? The answer is no. Now it continues to outperform. Can we predict when the underperformance will start? We don't know. So I believe that, and despite that, there are small and mid cap stocks we also tend to become positive on because they look cheaper than the other small and mid cap stocks. So I believe that, what happens is this is not something where you can predict anything with certainty. And the day you think that you know everything, then there is something wrong with you. And that is what we keep discussing in ICICI. There are so many things we think we know perfectly. It doesn't happen. This is a field where you have to recognize that we are always playing probabilistically, and there are times you get it wrong. You cannot get it right. And on March 8, 2009, market peaked, bottomed. On March 8, 2009 was the bottom of the stock market globally. On March 8, 2009, if you had gone and met people and said, today we are at the bottom, most people would have said, I don't think it can go down further. The reality is no one knows, because see, the market is made up of all kinds of people. Could you have said on March 8, 2009 that the market was cheap in 15 years back? Yes. But no one knew that day we were at the bottom. And that is something we have to accept, that, over time, you will realize that you can't get the bottom, you can't get the top, but you can get a fair value, fair idea that today we are not in a cheap market. That we know, but doesn't mean that markets can't go up from here.
Yeah. You've been a contrarian investor, for your personal investments also. I read this story and I was like really surprised that in 2013, when you know that the real estate valuations were too high, that in India, the interest rates were much higher than the rental yield that we are getting. And in the US, it was the reverse. That was the time you took a call, to sell your personal properties in Mumbai and Chennai and invested in equity market. Like, how sure were you then?
See, there's nothing called certainty, but actually I didn't know that there was a way of valuation that is there, which is that you look at real estate as a gap, real estate valuation as a gap between rental yield and mortgage interest rates. And that was something I realized because in 2003-04, mortgage interest rates were very low. And rental yield was the same in India, has been the same in India for almost all the time. That gap was very low at that point of time. In 2013, it had become very high. So valuations had expanded substantially in residential real estate, whereas equity was very cheap. So it became very easy. And look at it that way. You take, for example, REITs. Some of the REITs became very cheap in the last 2 years. So we used the opportunity to actually buy REITs in ICICI Prudential. My colleagues found some of the REITs very attractive, and those REITs have gone up only recently. And so what happens is you have situations where sometimes one asset class will be cheap, another asset class will be costly, and that is the advantage at various points of time.
Right. So the second important card, that we have to know about your style of investing is, the value investing. Value investing is very much part of the contrarian style of investing. So how do you define value, in your investment?
So actually, when I joined ICICI Prudential and started running value discovery, I used to use only price to earnings, price to book. And I ended up what Warren Buffett says, you end up with a lot of these gruesome sectors, like, which are always low on price to earnings and price to book. And I had a bad experience in 2007 when many of my the value investing did not work. So after that, we introspected at ICICI and said that, no, we have to look what he learned from Charlie Munger as value investing, which is that look more at quality companies. So we started broadening our outlook and started to look at sectors like pharma, for example. And after that, we have had a much better experience that don't just look at price to earnings and price to book. And you find that it is much better to buy a good business at reasonable valuations than to buy a average business at very cheap valuations. So that cigar butt approach has slowly transformed itself, and we have started to look at buying good business at reasonable valuations. And that model of value investing, I think, is much better when you're managing larger and larger sums of money. And I think clearly it was Warren Buffett who actually said that it was Charlie Munger who taught him that. And I believe that we learned from them, because otherwise, we would have been sitting with all low PE, low price to book stocks that alone would not have helped. So if you look at our portfolio even today we are looking at many of the quality value stocks rather than look at only the cheap value stocks. So in 2020, for example, we were looking at cheap value stocks. But today, if you look at it, many of the quality stocks have underperformed drastically. So that we are looking now at quality value stocks, not the cheap value stocks.
Right. I want to understand this. So value investing is in itself a standalone investing style.
Yes.
Now, on top of it, you're looking at the cycles.
Yeah.
I want to understand, is it because that value investing is becoming increasingly difficult that you choose to look at cycles as well?
No, I think what I learned when I'm managing public money is that you choose to look at, you can buy cheap value stocks, you can buy quality value stocks. And what we defined is, if you do only cheap value stocks, you'll have problems. At times you have to buy cheap value stocks, at times you have to buy quality value stocks. Today, for example, in our portfolio, at this point of time, after the last 4 years underperformance of quality, we are actually buying quality value stocks. So if you see the portfolio, it will be very different from 2020, when we actually had cheap value stocks which were very low on PE, very low on price to book. Today, if you see, we would have stocks which are actually quality stocks. So what we believe, that is cycle. Frankly, if we go back to a situation where the cheap value stocks have underperformed, maybe we'll sell the quality stocks and buy the cheap value stocks. That's what would happen. But I would say cycle thinking has got ingrained in us, because I think that has helped us a lot. Because otherwise we would have missed a lot of things. And today our approach to quality is again because of cycle thinking, because quality has underperformed dramatically in the last 4 years. If you look at many of the quality stocks, you would see that their underperformance is drastic.
So contrarian style of investing is at the top.
Yes.
And then this picking value stocks, whether based on valuations or whether it's a quality, value stock,
Yes.
something that will be decided based on, again, the cycle.
Yes.
Brilliant. When investors are understanding what kind of style you have, they should also understand what kind of style you are not. In one of the Morningstar, articles that you have written, that you, quote unquote, you said that money can also be made by structural investing, but that hasn't been my biggest strength. A few words about it.
Frankly, if you ask me, somebody could have bought, private banks in 94 and sat till 2024. Did I do it? Answer is no. I didn't do it. Somebody could have bought some retailing company 20, 30 years back and sat on it. Didn't do it.
Can you explain what that structural investing is?
Structural investing is something like, if you're sitting in US, for example, I think it's much clearer. You could have bought some of the tech stocks in US and like Microsoft or Google, bought it 10, 20 years back and then sat on it. So there were structural technology has been a structural trend. I'm worried whether 10, 20 years back, if I was a US equity fund manager, which I'm not, would I have done it? Is something I'm asking myself. And for a structural fund manager, when 20 years back, when Google started, they did not have any income stream. And still, people who bought Google made unprecedented amount of money. And I believe that, that structural investing requires a certain thought process to be able to visualize the future. And it doesn't require cycles. If you look at Microsoft, and therefore it doesn't require cycle thinking. You don't need to bother about cycles. You say technology is going to grow for the next 20 years. You just bet on technology. And say, I'm going to invest in this set of FANG stocks, what you would have done in US. I think particularly, in a country like US, it has actually worked much, much better than in most other countries. I don't know whether it's worked in other countries, but clearly in US, I can see that you could have just bet on FANG stocks, bought it, and then forgotten about it, and you would have made tremendous amount of money. So my worry is because of this style of thinking contrarian and looking at cycles, my view is I would have missed some of these structural ideas like maybe Google or an Apple or a Microsoft. This is my thought process. Luckily in India, we don't have that many structural stocks, but I do think that, there are sectors like retailing or private banks. If you look at the portfolios which I've been associated with, I have not bought a private bank and sat on it for the last 20 years. I've not done it in my portfolios. So that's what I ask myself, actually. Today, private banks may be a big part of my portfolio, but was it part of my portfolio between 2004 and 2024? Answer is no.
The third card that I think is very important in your investing style is temperament. Temperament is, how one would react during the difficult times. In investing, it's said that it's most critical. In the contrarian style of investing, where you are going against what the herd is thinking, is it much more important?
It is very important. In my opinion, I think my learning after being a CIO for the last 12 years, I think it's very important for every fund manager. And what Mark Sellers also says is it's very important. I think it's very important for a fund manager to have a good temperament, even whether it is as a contrarian investor or as a fund manager. Because finally, I believe, this is a world where information has been democratized. I don't think the information that any fund manager has and any individual has is very different, thanks to regulation also. If you ask me, almost all the data that we have is available to most investors in India today, thanks to regulation. I'm very happy with it. So the fact is how decisions are taken, I think is primarily based on temperaments. In March 2020 or in 2020, if you look to buy sectors out of favor, or for example, in Jan to March to buy some of the private banks where FIs have sold lock, stock and barrel is temperament. So I would say that, I keep telling my colleagues in my team that temperament is a very integral part of success as a fund manager. And I believe, forget fund manager, I believe that if you wanted to make money in investing in the next 30, 40, 50 years in your investing career, I think temperament is very important. Because think about it, in 2013, when I decided to take the call to sell out of real estate and put that money in equity market, the 10-year return on real estate was so much higher than the 10-year return in equity. But for me to do it was a temperament, frankly. So I think, it's so important to make money as an investor. Forget as a fund manager, I believe as an investor. Because if you end up buying real estate in 2013 by selling equity, you wouldn't have made money personally, if you ask me. So I think that's why I believe that temperament is sine qua non to make money over long periods of time.
Right. When you started your investing career, you said that you have a group, where you actually go and talk to them, share your woes. They share their woes. It's like this alcoholic anonymous group. That support system is required, for the right temperament. Right?
So we have created a support system in our company. So for example, in every stock, where we go wrong or even where we go right, so we have our own support system. So if we go wrong in power, we have 3-4 people. We all have our discussions together. Why did we go wrong? Have we gone wrong or have we gone right? So otherwise, you take a sector like power. First 2 years, we went totally wrong. Then next 3 years, you've gone totally right. So if we didn't have that support group within our company, now we can't have it externally. So we have to have it internally. So internally, we had a support group on power. We had a support group on telecom. We had a support group on metals. who are all part of the support group are people, the analyst is part of the support group. Then there are other people who own the stock who are part of the support group. So without that, you cannot, because it's not that the day we bought metals, the next day we made money. We first went through a heart-wrenching process of losing money relatively. Then after that, we made tremendous money, but that required internal support groups. And in different support groups, you have different participants. And that's how you manage to hold on to the stock. Otherwise, you can't hold on to a stock. Because in power, first we would have lost 30% relative alpha. After that, we may have got 100% relative alpha. But how do you handle that first 30% negative alpha?
You also once referred that, the pressure doesn't come from the institution, but the pressure comes from within first.
Yes. See, finally, at the end of the day, when we are fund managers, we are managing public money. And like recently I went to a concert. So in that concert, I met 7 old people who are all between 65 and 75. They said, our retirement is good because of our investment in your mutual fund. I told them because of the market. Because I was thinking that suppose the market went down, how would I know? Go to a concert, because then they'll say, we lost money because of you. So I had to tell them market also.
Right. And how well, the routines, tools, frameworks, in an investing process helps the temperament, to be?
It depends, but first you have to create the right culture. So what happens is the culture within the firm enables us to handle the stresses of the job. Because markets will be like this. You can't change the market. At times the market will be in your favor, what you think. At times it won't be in your favor. So you have to create the right culture within the firm to handle the stress of the job. So we go through that, and that is part of it. It can't be helped, because this is not arithmetic. The market doesn't need to listen to you. The market can listen to somebody else. Did anyone believe that as interest rates went up also, equity market across the world will do well? And today it's even worse. Even gold has started to go up. Silver has started to go up. Everything has gone up. Interest rates have gone up. Gold has gone up. Silver has gone up. Oil has gone up. Equity market has gone up. Did we predict it? Answer is no. So I believe that, that's why I believe that, finally at the end of the day, we have to learn, we keep learning, we keep making new mistakes, and then we have to learn from the mistakes, and therefore it's a continuous learning. I keep telling people in 1980s, when I was studying engineering, there was a word called Kaizen, called continuous improvement, because in those days, Japanese ruled the world everywhere. So that world was continuous improvement. So on a continuous basis, we have to keep doing Kaizen, because there is no way that Kaizen word is in my mind, that you have to keep learning, because what we didn't know earlier, we have to keep learning.
Right. Talking about the temperament, I think listeners also should know this story that in 2000s, I think when the market, after the crash, when the market sentiment is too, poor, you were offered a job in IT industry.
Yes.
I think the temperament to hold on to that, investing job and not succumbing and going to the IT is also a good temperament, not just holding to the stocks, right?
Exactly. For 35 years, being in financial services industry was something connected to equity market, and now connected to the entire mutual fund industry was something which was difficult in 2000. Many of the people left the equity markets in that period.
Does having right temperament means becoming unemotional?
Yeah, that's what my guru Howard Marks says. You have to be unemotional, because otherwise, you can't be so emotional about investing. You have to be able to take decisions which look, it has to be very unemotional. You can't be so bothered about every investment decision. If you are so bothered, then you can't take those decisions.
That's why you were saying that a part-time investor can do better job than a full-time investor in stock market.
I tell people, big bull markets, you think that you should become a full-time investor. Do anything. You can do anything, but don't be a full-time investor. Even Warren Buffett and Charlie Munger were not full-time investors. They manage so many companies. If you think carefully, They created so many businesses. They ran so many power plants. They did so many. They ran entire railway kind of companies. Their insurance company. So my belief is that the worst thing to do is be a full-time equity investor. See, you may think we are full-time equity investors, but we are managing public money, and there are so many things you have to do. So that's why we are not, in that sense, we are not concerned about day to day. The day you become a full-time investor, it's a problem. There are only very, very few people who manage to be full-time investors and actually succeed significantly. I believe that it's very good to be part-time investor.
What would you have been if not for in this investing, probabilistically?
I enjoyed at one point of time software industry at one point of time, but now I lost all. I have got so full-time involved in this that now I've become so much involved in financial services and markets I can't give up on markets. That's the problem.
Now, I think the fourth most important card to know about your style of investing are the funds that you are running directly. Of course, there are about 13 funds that you're managing directly. Right? Let's take equity funds. There is like Value Discovery, there is India Opportunities Funds, other thematic funds. Now, each has its own mandate. There is Contrarian style of investing and the value investing that's at the top. How does this style reflect in these funds managing with their unique mandate?
So actually, I work with my colleagues. So there are funds where I manage to effectively most of the work is done by my colleagues in some of the funds which I run, because I don't have the time to involve myself. I'm there, but my colleagues and they've all worked with me for long, so I can comfortably work with them. So my colleagues do a lot of the work. I'm definitely involved in a much more direct way in Value Discovery and India Opportunities, but in all the other funds, I'm there to help. But the fact is that my colleagues know exactly what I want, and they have worked with me. They have been analysts, they have been joint fund managers, so they know what I want in the fund. So otherwise, I won't be in a position to run. In Discovery and India Opportunities, certainly I'm there. And there I would say that, I try doing, one is a special situation fund, another is a value fund. So in those two funds, certainly I'm I'm very happy, of course, with the way the company created Balanced Advantage Fund. See, we created Balanced Advantage Fund out of the sadness that I had in 2009. See, if investors had sold in 2007, bought in 2008, by the time 2009 happened, they would have actually had a very, very good experience. That did not happen. Essentially, the reverse happened. Investors invested in 2007. They didn't invest in 2008, and by 2009, they asked, what did we do? So what we did was we created this category, and I was very happy that my CEO Nimish and sales team agreed that we have to focus on this category. Then when COVID hit, that was the only big meaningful fall that has happened. We benefited because in 2020, we could do exactly what 2007, 8, 9 got replaced in 2019, 20, 21, which means in 2019, we sold. 2020, we bought. 2021, when the market rebounded. So by the time 2021 happened, what had happened was that the 19, 20, 21 experience was so positive that the investor actually felt that they gained from this entire market volatility, which was the entire goal of what we were trying to do.
Right.
So after that, we realized that what the fund did not have was gold, silver, etc. So we actually started popularizing multi-asset fund. So that also has gained scale. And now again, the industry is also launching multi-asset funds. So I believe that this whole thing now of trying to get, finally at the end of the day, what is the goal that we have? To ensure that the public makes money out of these strategies. And that at lower risk. And that is what we have been trying to do, and it has been a very positive experience. In Discovery, which is a value fund, definitely that entire thought process of contrarianism with an emphasis of value investing and thinking of cycles has been going on, and it's been a very pleasant experience.
Right, right. I want to get to the BAF in a bit. Just sticking to that India Opportunities Fund, for example, it's investing in special situations whenever there are special situations. Now, I just want to understand, how does this style of contrarian and value investing reflect in that? Because it's, again, at the end of the day, only special situations. How does it reflect?
So actually the idea came from a person called Anthony Bolton. He ran a fund called Fidelity Special Situations. It was one of the most successful funds globally. And I read his book about 5-6 years back, and many years back, 7-8 years back. And when I read the book, I realized, how can we not have a special situation in it? Because it met all my requirements. So I felt that it was very enjoyable. So you buy something completely bombed out, you do something which is against what anyone wants to do. And what I felt was, why is it we don't have? Actually, Fidelity had launched the Special Situation Fund when they came to India, but then Fidelity sold off. Yeah. So I said, we should definitely do it. So we managed to get this fund launched, and it was totally in line with what I enjoy doing. And after that, we have done special situation investing. The first 2 years of the fund was not doing well at all. So a lot of people used to ask me, you said special situation is such a great category. But what I realized was, in special situation investing, when you invest immediately, you won't get the return. The return comes after 2 years. So the third, fourth year has been very, very good. The third to fifth year has been very good. But the first 2 years, you don't make money, because when you invest in a special situation, it takes time for the returns. So now, with the very good performance, now I have to tell people, don't invest money. Because the problem is, people think always you'll get these kind of returns, and returns may not come. And always special situation investing, you may not get that good ideas like what we got in 2020 in a COVID year. So we said, now you have to slow down investing, but the fund continues to do well because we are always looking for special situation. But think about it, special situation is very much more contrarian. The advantage in it is we don't look for cheapness of a stock. So for example, we had a retailer. That retailer started to go through slowdown because they couldn't sell gross merchandise. So we invested in that retailer. That retailer P is 100 P. But we didn't care because we could buy that stock because it fit the special situation mandate. So those kind of things we can do in this fund. So it's very enjoyable because you're doing things which people won't be able to do in other funds. There was a time we had 20% metals almost. And there wouldn't have been a fund in the industry which had 20% metals. And we sold off, made it zero at some point of time.
If you have to understand the difference between value discovery and the special situations, in value discovery, you look at this top-down sectors first, contrarian style of investing. When it comes to this special situation, can we say that the focus is more on the stocks cycle?
Yes. We are focused on the stock, and we won't bother about whether it is costly or cheap. So there'll be a time we'll buy 100 P stock. There'll be a stock, you will have sometimes stocks in this portfolio which need not be value in any way. When we, for example, there was an MNC which had a problem because it sold a division too cheap. The share fell. So we bought that stock. Did that stock have value per se? Answer is no. But we bought the stock, which we couldn't have bought in our value fund. So that's why we will not bother whether the stock is value or not, but we will buy that stock. That is how the difference would come.
Now, the most important question, Naren, what should investors investing in these funds should expect? Now, as you said, value discovery, there are times when it does like really well. There are times when it could be just aligning with the benchmark. Like, what should investors know when they're investing in these funds?
See, basically, the thesis that I have is that, which we try to say is, when any fund does too well, I tell people do SIP. When any fund does very badly and you trust the fund manager, do lump sum. This is my broad process that I believe in, actually. Otherwise, because otherwise what happens is people think that always you will do well. It's not going to happen. Some other things are going to mean revert. The reason why we like hybrid kind of strategies is there are so many variables there. Sometimes you can get return out of debt. Sometimes you can get return out of market volatility. So those are actually funds where it meets the requirement of the investor, because there you are not dependent on one variable. But if you are investing in a pure equity fund, and that pure equity fund which is run by any fund manager has done too well, it is bound to mean revert. Because all strategies, if you ask me, as I said, the only things which need not mean revert is you've got the structural trend right. And that structural trend is always, that person gets it right always. Then maybe. But as I said, in India itself, are there so many structural stocks we don't know? So that itself becomes a challenge. That is why I believe it is much better to, if you trust the fund manager, it is better to invest after underperformance. And otherwise do SIP. SIPs are safe because then you actually get to invest when they do badly, you get more number of units. That is what. Otherwise, there is a mean reversion. Forget what the regulator says, past is not equal to future in performance. It is bound to mean revert, and that we have seen over a long period of time. Even in a fund like Discovery, which has a long history, there have been 2 periods of time when the fund didn't do well. 2016, 17, 18 and 2006, 7, 8. That's what has happened.
Yeah. Is that what investors should remember? That's my question. Next question. Even when the funds are not performing, there are mutual fund distributors or the analysts or, the investment advisors saying that this fund itself has that style. It will play out when value does well in future, and they're stuck to it. Similarly, what should, there could be other investors who are like DIY investors. What are the cycles that they should hold on to? Or is there a time that, when growth is doing well, it may not do well? What is that they have to remember?
I'm very worried that people are just looking at 3-year best returns and investing. Actually, I had a model which I've told many people. You want to make more money, invest in any fund which gives you minus 40% on 1-year basis. Or on 5-year basis has given you 0 return. Only thing, if you can get your investor, get your company to talk to the fund manager and saying that person will stay with whatever style you have followed. If the fund has delivered 3-year minus 10% per annum, tell that person, will you stay with that style? If you buckle, there is a problem. Otherwise, many of these things will mean revert. That's what I try to tell people. But to communicate this to people, I find it so difficult. I can communicate it very easily in this podcast, but it is so difficult to convince people that in 2018, that Discovery had bad 3 years. Now this is the best time now for lump sum. Now in 2024, I try to tell people that in India opportunities, because last 3-year returns is very good, do SIP. Very good idea. Tough, but this is what we believe in, and that is why over a period of time what we have seen is, otherwise you should have multiple areas of alpha creation, which happens, for example, in multi-asset. Sometimes last 3 months gold silver goes up. How did we know gold silver will go up? Even I did not know so much it will go up, but sometimes that can help the investor. Did we guess that? Answer is no. But that way, some of these hybrid asset class funds, at least you have diverse ways of creating alpha. In pure equity funds, you have one fund manager or 2 fund managers trying to create alpha. So the mean reversion possibility is higher. In hybrid funds like multi-asset, sometimes gold may give you return, sometimes equity may give you return.
Right. So we can clearly say that, maybe balanced advantage fund or multi-asset funds are your favorite?
No, our belief at ICICI Prudential is we need to get more number of investors to participate in this mutual fund journey. The scale possibility in these funds is the best because of the nature of the fund. It is not that there is anything wrong with value discovery or India opportunity. The scale opportunity in balanced advantage fund or multi-asset or equity and debt is higher than in a fund like India opportunities. That is what we like to tell people.
Scale opportunities.
You can manage a lakh of crores more easily. I mean, of course, small cap and mid cap is even worse. But I'm just saying that to manage 1 lakh crores in balanced advantage or multi-asset, because it is investing in so many things, it counter-cyclical. I believe the chance, it is much better than in, of course, small cap will be much worse. I'm just saying is much better. That is the thing. And that is the objective of ICICI Prudential Mutual Fund.
Right. I was talking to one of the mutual fund distributors and I asked, what's unique about ICICI Pru Mutual Fund and the CIO. So they were saying that there were times when equity is overvalued. It's one of the very few fund houses who comes and says, hold your horses when investing in equity, choose hybrid funds. There are very few people who actually say that. Can we say that, downward protection is the motto for ICICI Pru Mutual Fund?
See, the reality is that since I have worked for 35 years and ICICI goal is to be one of the most respected houses, what we learned was that equities has given very good returns over the last 35 years. But it's such a small industry compared to other industries. Why did it happen? Because investors lost money. So that's why we realized that if downward protection happens, automatically the industry, the company, scheme, everything will be bigger. That is what we realized over a period of time at ICICI Prudential, and that is why we did this. And at the same time, in 2020, if you look at it, one of the practices that we have had is every month do a call. So if you look at our monthly calls in 2020, it would be like put money today. Because at that point of time, markets were cheap. Whereas if you hear our calls today, we will say put money in hybrid because markets are not cheap. So that framework we have found very useful because finally at the end of the day, investors should be happy with us. If investors are happy, it's a limitless business.
So the next important card here is as Naren as CIO. Why don't you just give us some sneak peek about, how your day-to-day, is like as a CIO for one of the largest AMCs in India?
So I've done this job for 12 years and I never thought I could be a leader. So because I'm not used to being a good leader, so I learned a lot of things. Like I learned to communicate. So if you go back and think at 15 years back before I became a CIO, I did not know how to communicate. So first is that as a CIO, you should know how to communicate. So like I tell people that first you should know at times you should be in first gear, at times second gear, third gear, fourth gear, fifth gear, and at times in reverse gear. So how to communicate to the street is something that I had to learn. The second is that, I worked very hard in creating an internal team and training them, and they supported me brilliantly. So like one of the things I've been happy, I'm not saying in future it will continue. In this 7,40,000 or 7,20,000 crores that we manage, we don't have a fund manager who has worked in any other AMC. There is not a single fund manager who has worked in any other AMC. The entire 7,20,000 crores is being managed as of now, at least by people who have only worked in ICICI Mutual Fund as fund managers.
Why that philosophy?
That philosophy is therefore the culture becomes very easy for me. I'm not saying I'll be able to maintain it, but I'm saying it has helped me to maintain a certain culture. And that happened only because of the good work done by all my colleagues whom I recruited, trained, and managed to create that culture in our company. That has helped us to create, as I told you, support groups when we get into some problem on some sector or stock. For example, a few years back, we invested in floating rate bonds in our debt fund. It was something which didn't work for some period of time. It was such a fantastic investment, but it finally worked. So again, we needed a support group in debt for that. So I believe, it's tough to have this situation that, we have managed it, that we have grown to this level. We have lost people to the industry, but we have managed to grow it internally. And that has been one of my happy moments, that there have been so many internal people who have grown to that role. Will I manage it in future? I do not know. But that has happened till now, if you ask me. And it's not an easy job, because it is a job of managing public money. And in my opinion, the easiest part of it is that we have not seen meaningful corrections. Even if the correction happened in 2020, it recovered fast. So I think till the first correction, it will be an easier job. That is how I see it, and that is the reality. But otherwise, it's been an enjoyable job for the last 12 years, but it's been very demanding.
Okay. As CIO, you're happy, but do you miss that like hands-on complete? Of course, you're directly also managing value discovery and the opportunities, but like sitting and like completely researching, because as CEO, as CIO, as you said, there are other demanding tasks as well. Do you miss that part where you completely focus?
No, I don't, because say finally at the end of the day, if I wanted to do that, I can do that. Yeah. The fact is that if I enjoy the task of managing what I'm doing. If I didn't want to do it, I can do what I want to do. And see, finally at the end of the day, you do what you enjoy. Otherwise, it doesn't make sense. See, 20 years back, I did not know macroeconomics at all. So I learned macroeconomics. When I joined this firm, I was actually a micro-cap investor. So I ceased to be a micro-cap investor. So you have to, as long as you enjoy coming into work, it is good. If I'm comfortable, and it is not that, when my colleagues come and ask me for suggestions, can I do that in that process I'm involved in. So it is not that I'm hands off completely. And so I wouldn't say that I'm not enjoying it.
Now, and at multiple forums, you also said that as a fund house, you don't want it to have a certain single style.
Yes.
Right. So you have a certain style. We talked about contrarian value. There are other fund managers also that you are training. So is there any other style that we could see in other funds?
Yeah, I mean, if you look at it, almost all fund managers in the company are allowed to pursue. So if you look at Balanced Advantage Fund itself, where I'm a co-fund manager, the equity portfolio of that fund is run differently. If you look at the portfolio, you won't see any style that you think which is associated with the way I run funds, for example. Okay. So if you look at so many funds,
Can you elaborate on that?
I mean, you see the top holdings of the fund. It is run with a growth style. My colleague Rajat, who is a co-fund manager in that fund, believes in growth style investing. So he has been running it with the growth style for years. I don't think it has changed ever. And if you look at Anish, for example, he has a specific style. Different people have been, if you look at Vaibhav, he has his own style. Lalit has his own style. So, and some of the other people, they follow style closer to contrarianism, not because they want, because I run the funds, because they themselves have started to believe in my style. That's how I look at it. Actually, people like Mitul or Ihab, they all have started to learn my style. Roshan runs his own style. So different people are developing their own styles.
Got it. Once you also said that at the end of the day, when you're going to home, this question of, are you running the fund the way it is run, the way it is run, the own personal money. So how is it that you want to run, maybe in single word?
See, I think, no, at the end of the day, I should not feel I should not have done this. And I believe that I would say that ICICI as a sponsor is an amazing sponsor. It's not owned by anyone. It is, and there is no owner, specific owner. The way they tell you is that you run the company the way it has to be run. So the whole thing starts from the sponsor. And it is such a magnificent thing that we run the entire company for the benefit of the investor. And what Mr. Sandeep Bakshi also says is, take care of the brand, protect the brand, take care of the reputation. And from Sandeep tells that to Mr. Nimesh, and that is what has been told to me. And on that basis only the whole company is run. That is why, our mid-cap fund was not doing well, but now it is doing well. Just when it did well, we closed it for subscription. So the fact is that we don't have to bother about it in any way. that why are we closing when the fund is doing well? That kind of framework we don't have to bother about. So I think one of the reasons, if you look at my own career, out of 35 years, 20 years spent here, the advantages here, no, we have always run everything for the benefit what the investor is needed. And that's why if you see our monthly calls, we tell them now from here on we don't believe in these categories. Now, can that result in redemption in those categories? We don't worry about them. And that is the advantage of this. The day we have to worry every day about whether we can say this or not say this is a challenge. At the same time, you have to remember that investing is not arithmetic, so we can go wrong. We cannot predict the market top. We cannot predict the market bottom. What decisions we take, we will take on what we think is logical, but sometimes we can go wrong. Did we expect that the small cap and mid cap will go to this level? The answer is no. So, contrary to what people think, we can go wrong. It is not that our intention is to go wrong, but at the same time, if any investor anywhere in India can go wrong. And I keep telling people it is impossible for any fund manager to get everything right. As I used to joke in some of the events, there were only two people who could predict the market tomorrow, which was Ketan Parekh and Arshad, and both went to jail. So there is no such effort. Our effort is you follow a process, follow it in a disciplined way, invest thinking you're investing for the investor. And you have to remember, you have investors from Guwahati to Ratlam to Dwarka, from Kanyakumari to Kashmir, and think carefully you are investing on their behalf. You may make mistakes, but that is part of the deal. But the good thing about our sponsor is they are very clear you have to take care of your money.
Right. As an institution, I understand, there'll be already set policies, everything are there. But, as a CIO, your wisdom, your, mentoring to other fund managers is also very, very critical. So how does ICICI think about the key man risk here?
No, if you look at Anish, for example, he is a very senior resource. We have many people. I was saying we have almost 20 people in the investment team who have spent more than 5-6 years in the department. And we have one of the largest investment teams in the country. As I told you, we have built this entire company without hiring a single. There is no fund manager in equity and debt who has managed money outside. So imagine how much homegrown talent we have created in the company. And there are so many people in the company who spend decades with us. And they're all running key funds also. So it is a complete structured process that we have created where a person joins as an analyst, runs one or two sectors, then becomes a joint fund manager, and then becomes a senior fund manager. We have created a complete process, and that is how we have done it right through, actually.
Right. Before we go to the last card, just one thing. Adil was also saying that, when you started your career, you used to carry the annual reports in your suitcase, and that's how, you got into the fund manager industry. Why don't you share that story with us?
No, see, end of the day, this is a field, where you have to outcompete the benchmark, and it is a competitive industry. Contrary to what people think, and it is a competitive industry. The benchmark has today low cost. So if you have to deliver alpha, you have to do continuously, you have to be on your toes. And that is the reality of this industry. So people think that you can achieve alpha, you can achieve a lot of things by taking life peacefully. It is not going to happen. So it requires it requires good temperament. It requires, as I said, I'm weak in identifying some structural ideas. So you have to use your contrarian and cycle capabilities and your ability in value investing to outcompete the benchmark. And if you don't do it, and for that you have to do all that it takes within the rules, within the regulations of the regulator, without doing anything which is illegal, etc. And you have to do it properly. So, you have to do it properly. For that, you have to work hard. That is the reality of the situation. That's why I said that we have to learn macroeconomics. You had to learn how to manage scale. All these things have been what was needed over a period of time.
Right. And the last card is about investing gurus MMM, James Montier, Michael Mobison, and Howard Marks. Through your whatever you say in multiple forums, it's clearly understood that they have had a tremendous influence on your investing style. Could you just tell us one investing lesson that you have learned from each one of them that has actually molded your investing style?
See, the different things. For example, James Montier wrote a piece called 10 Tenets of Investing, in which he talked about being unconstrained. So people ask me, I made this talk on Saturday. Unconstrained means you're allowed to do anything. So that's how we created the multi-asset strategy. You can buy almost anything. That is needed for success, because at a time, gold may be cheap relative to other things. At a time, REIT may be cheap relative to something. So you should be able to buy anything. So if you look at Michael Mobison, he taught us pre-mortem. So if you have an election, you will think today, what will you do on the day after election? You can't afford to think. If you have a budget, you think beforehand, what will you do after the budget? So we do pre-mortem meetings. See, this post-mortem is only throwing stones at each other. So we do pre-mortem. What will happen? What will happen? And when we do pre-mortem, there is no question of stone throwing on each other. You think, what should we do? What is the probability of this? What is the probability of that? What is the probability of US election? What is the probability of oil going up? What is the probability of a bad monsoon? All these things we do pre-mortem. And that pre-mortem has helped us significantly in taking calls at various points of time on different things, actually. So I would say that is what it is. And on Marx, clearly it is cycles. And what you showed also, that top of cycle and bottom of cycle, those two are clear. And we have learned that in the middle, you can't judge. You can't judge that middle. Like, for example, in debt today, we are somewhere in the middle. I have not been able to help the debt team because they don't know where we are in the cycle. If you are in that extreme, it is very easy to judge. What Howard Marks taught on cycles, I just can't forget. Maybe I knew the word. Maybe I know I was thinking on cycle. But the way he put it theoretically to me, after that, I could always think of that clock and say, which end am I in? Am I in the middle? If I'm in the middle, I keep my mouth shut. If I'm in the extreme, I'll tell everyone we are in that extreme. Be careful, be careful. If we are in another extreme, I say, be aggressive. Let's buy. So that is what Howard Marks taught us.
Is pre-mortem equivalent to second level thinking?
Second level thinking is like, for example, if there is a CEO change, for example, 2 CEO changes happened yesterday, on Saturday. On that you do second level thinking. But this pre-mortem is thinking 2 months back whether those CEOs will change. That is pre-mortem. Second level thinking, now the CEO changes happened. Is there any other thing which we have to think about? That is second level thinking.
That's all. Maybe just last 5 questions quickly, a rapid-fire question. You can just answer it in single sentence or so. Now, how do you invest your personal money?
See, broadly, we have been investing in hybrids. And suddenly I'll wake up and say, I have to find this contrarian idea. And if I find a mutual fund scheme or an ETF which meets my contrarian need, I'll do it. That is how I have been doing it. That is this thing. And, I felt very comfortable not being invested in any equities for more than almost a decade. And very comfortable.
You being an investment manager, you spend a lot of time looking at others' portfolios. Do you take enough time to look at your portfolio?
I think what happens is, I believe, I think that person said, there's something called enough. Beyond a point, money cannot make anyone. What will you do? We are all South Indians. What can I do with that money? That is how I see it. And that is why it doesn't worry me.
What's your stress buster? You said, CIO job is very demanding. So what's your stress buster like?
I play computer bridge every day for some time. And I listen to Carnatic music. I listen to A.R. Rahman. So these are the things I do.
Any book recommendations for our viewers or anything you watch?
No, I sometimes watch some movies. My son is a special child, so he likes to see movies, so I see movies with him. Otherwise, I do read books, but I read all kinds of, I sometimes read management books, I read some investing books, sometimes some politic book. But I'm not as voracious a reader, but I'm struggling to manage time.
Are there any books that you recommend our viewers that you should be, one?
I think a good summary book is, I think Gautam Bed's book is a good summary book. The older book.
The Joy of Compounding?
Joy of Compounding. It's a good summary book of all the other gurus. Actually, is I think good. Is done a good summary.
I understand. Yeah. So my last question: what's your way of giving back to the society? How do you look at that?
I have to think more on it. See, as I told you, I have a special child, and due to that, how I should do it relative to that is what I'm thinking. Considering that I have nothing beyond my special child, I have to do that. But certainly, I'll contribute somewhere on the investing area. Certainly, I'll contribute. But other than that, I have to do something, considering that all the problems that special children have and special children parents have, that is an area I have to contribute. But right now, I'm still not yet focused on it, but I'll do something in that area.
Awesome. Thank you so much, Naren. It has been really informative and a lot of respect to you.
Thank you.
Thank you. Disclaimer: mutual fund investments are subject to market risks. Read all scheme-related documents carefully.